Well, Charles, it's noon on Monday, so it's time for Mile High Market Brief. Let's get started.
Yes, sir.
All right. First up today is a report from DMAR Market Trends Report for Denver, and we noted in here that Colorado has moved up 9 spots to number 18 in Realtor.com's 2026 housing report card. So we're getting scored a little bit higher. Why? What's happening that's caused us to move up 9 spots?
Yeah, right. So as we look at this, we can kind of see some of the things that are happening, and we look at it and we can see that okay, so median close price has gone up, and I think that one of the important things to know as the real estate economist, the choice is the difference between average and median, right? So with your median price point, we've taken all of the lower priced homes and we've taken all the the expensive homes, and we've made it all the way to the middle, and so that middle dollar amount that homes are selling for in Colorado is $616,000 versus an average. And just so that we can understand what an average would be, that would be all the sold homes together divided by the total number would give us an average dollar amount. So $616,000 is your median price point in Colorado. And I think that's very important, Russ. Like as we're looking at this number and we're talking about affordability inside of Colorado, with interest rates being what they are, this is 100% driving the affordability issue that we have.
Yeah. So people talk about median and average kind of like they're the same thing. And yet, what median does is median helps us. I kind of think about median as like, what's the typical home? Like
Yeah.
if you take a bow and arrow and shoot it into space without aiming at anything, what are you going to hit? Well, in Colorado, you're going to hit a $616,000 home. It accounts for what's happening in Aspen with a $120 million property. That goes away when you think about median, right?
100%. And then when we look at the stat that's up here as well, 41.4% is what it takes of the household's total income to go towards housing right now.
Yeah,
I mean, that's
which
something.
lies a bit outside of what lenders really want to do.
Right, like everything we were taught in real estate schools getting thrown out the window at this point when we're talking about financing.
Yeah,
And this is what we're running into in Colorado, which brings us to that third bullet point. When we look at this, we have three municipalities where the starter home, guys, like the starter home is above $1 million.
right.
And we don't have condos, right? We've talked about this on previous calls to where we don't have the condo population that a lot of these other states have because of the regulations where we have the statute of limitations that's exceeded most areas to where condos are not being built here. So when you're talking that you have a starter home that's $1 million, that's nutty to me.
So closed homes down 6.62%, and that's June versus the previous month, May. Volume down 5.79. So volume's down a little bit less than units, which accounts for median close price going up just a titch. Month supply of inventory got a little bit more, 6% more, 3.25 months, 18 days median in the MLS, which is up pretty significantly. Although, like 18 days is a ridiculously low number historically
Right.
speaking. And inventory went up. So inventory up 4% um, during the same time period. A couple other interesting details across Denver, starter home 405. Denver ranked number two nationally for recent college graduates because we pay our people well here. And it's one of the country's highest, one of the places in the country that has the highest rates of rental concessions, meaning we make it a little bit easier for people to rent homes here.
Yeah. Absolutely. So very interesting numbers as we're going through and we're looking at this. And yet, to Russ's point, right? 18 days is our median days on market. Price points going up. And the reason why price point is going up is because there's still just not enough inventory, right? Even though we're looking at this 3 months of inventory, which is also up, we don't have enough inventory to satisfy the needs of everyone that's looking to buy right now. What this is just saying to me is that we have a lot of homes that are priced too high that aren't selling. And we're just seeing that that inventory sit on the board while more inventory is coming on and prices are still going up because if it is priced right, those houses are commanding more dollars at this point.
Yeah. You mentioned, and I noticed you added to this slide, record high June inventory was '06,
Mhm.
31,000 homes on the market in '06 compared to last month, 3,100. So 90% down, which is really interesting. If you've been in this industry for a while, um, that's kind of a mind-blowing number, isn't it?
Yeah, absolutely. When we're looking at this and we're thinking like, hey, the kids are out of school and some moves maybe be happening at this point when we start talking about, you know, consumers and agents alike both falling asleep as jack-o'-lanterns, waking up as Easter bunnies, starting this cycle of buying and selling real estate. And it's slowed down a little bit. And again, it's because what we're seeing again is the dollar amount that costs to borrow money is so significantly high, especially at the $616,000 price point that it's just slowing some people down.
Yeah. It's fascinating to think of when I was buying a home, I bought a home in '03. I don't think I bought a home in '06, maybe. But to think that there's one out of every 10 homes on the market today as compared to then, that's kind of crazy. Charles, what's this business about workforce grants and why is that applicable here?
Yeah, what's interesting is we're looking at this and it says Denver's investing, let's call it $1 million, let's round up. $1 million to train technicians in heat pumps, solar energy, EV charging, and clean energy. And so this is what we're seeing in Colorado right now. We're seeing a huge pivot from what we would consider dirty energy, or someone would consider dirty energy from coal plants, and they are moving more towards this cleaner energy. And so we're seeing politicians, just like what we've seen with housing initiatives, that we are going to be moving towards this as well. So they're going to spend $1 million in grants to train technicians to focus on more cleaner energy, including these heat pumps, which is kind of interesting that we're seeing houses right now where this is what's truly heating their homes are heat pumps right now. And they're getting off of this other bigger energy consuming products that are out there so that we can move into more of a net neutral environment here in Colorado.
Yeah, interesting stuff. So moving from the market in general to luxury homes. The luxury market continues to outperform the broader housing market. Luxury homes rose, home prices rather, rose 4.7% year over year compared to just 1.5% for non-luxury homes. And I think the basic message here is that affluent buyers don't care about mortgage rates. They don't care about down payments. Most of them are buying with cash, and I think the other piece of the story on luxury is luxury buyers are buying wherever they want. Like they're not concerned so much about where. In fact, I was talking to somebody recently, and they're looking at a luxury price point. They're looking in Idaho, they're looking in Utah, they're looking in Colorado, and so it's kind of a different world there.
Yeah, absolutely. I think that when we look at this number and we just talk about inflation, and inflation's obviously the conversation that we're going to be probably having week over week for the future conversations that we're going to be having. And we know that inflation is a threat to democracy. And what we mean by that is this: when we're looking at the lower class, the middle class, and the upper class, when we start having inflation, inflation indirectly disproportionately affects the lower class, opposed to the upper class, to Russell's point, is they're spending cash. They have other assets. They are more liquid, and so they are not reliant on the cost of money from the bank. And so what we see when we look at a news headline like this, where we're like, hey, their luxury homes are still selling. Well, luxury homes are still selling, and what's happening is luxury homes are going and the affluent are not borrowing money and they're able to go through and buy more property, more assets, and other things that are happening. And then the middle class is being pulled one way or the other to where there's a bigger gap in the middle class. And the lower class is what we're seeing is, well, they're not going out and buying real estate. They are going out and they are borrowing money for other expenditures. And that's what happens is that we just have this bigger and bigger gap when we see articles like this.
Yeah. I think this slide's really important because it informs how you talk to your clients. Like when you've got a luxury market that is far outperforming the regular market, every statistic that is about the whole market is skewed just a little bit.
Hmm.
And that's why I think it's important when we have conversations with our clients that we may study like the price point that they're looking in to see trends within a price point rather than homes are up, homes are up 1.5% in terms
Yeah.
of prices. Like that's not a real statistic because that's skewed by the luxury end. So it's important to make sure that you're talking apples and apples when you're talking about trends.
And we were also having this conversation when we were back during the pandemic, is that if we were to keep on the trajectory that we were on during that time, is that by 2030 we were going to start seeing that the average price point in Colorado was $1 million. And when we look at this and we look at that bullet point, that second to last bullet point, it says $1 million homes are becoming more common. Almost 14% of all active listings today are at $1 million, which is up 9% pre-pandemic. So 2019, what we would consider a normal market, we had 9% of all listings at a million. And fast forward to today, 14% of all active properties that are
Yeah.
on our MLSs are
Yeah.
at $1 million or more,
Yeah.
which is wild.
Yeah. We'll be at 20 something by the end of the decade.
Oh, yeah.
Institutional investors are selling more homes. We saw institutional investors doing more. Net sales jumped from 593 homes in Q2 2025 to more than 3,000 homes in Q2 2026. What's this about?
Yeah, like when we look at this, this is interesting because we saw these news articles that were circulating around about what's going to happen in the housing economy, right? We saw the silver tsunami, we saw the housing crash, we saw the Airbnb bust, and all these things were supposed to put an influx of homes to where the home prices were supposed to just come crashing down. And it was this scare tactic on whatever news cycle that you were watching. And yet, this is what's interesting. We are starting to see an uptick of institutional investors. So not mom and pops, not a single buyer who just went out when money was free to go buy an Airbnb so they go hang out during the summer months or the winter months and trade some of these out. But institutional investors are putting more of their inventory online to sell right now. Not huge, but percentage wise, yes. I mean, we're talking more than 3,000 homes. Like when you look at this number, Russ, like, cool, 3,000 homes between institutional investors is what they're putting up for sale right now. That's not an exciting number.
Yeah.
But what's driving this number is something that is very near and dear to all of our hearts, right? When we look at this and we're talking about insurance rates, we are talking about all of the other things that affect the cost of housing. This is what's making some of their decisions. They're looking at it and they're saying, okay, are we delivering the profit that our shareholders expect with this asset? And if it's not hitting a certain dollar amount, they're going to be liquidating it.
Yeah. I think what's important here is this last column. So if you read the details on here, these are all net numbers. So Invitation Homes, to use the first line, Invitation Homes sold 520 more homes than it purchased, and Vinebrook sold 575 more than it purchased. In other words, we're seeing institutional investors offloading inventory and holding less real estate. And I think bullet point three is kind of the point here. There's legislation sitting on Donald Trump's desk right now that would restrict what somebody can do in this space, or what an institution can do, what an institutional investor can do. And I think these large investors are saying we better reduce in order to stay in the game.
Yeah, one of the things that NAR put out was that they weren't strictly for this bill, the bill that you just talked about, Russ. And what's interesting about this was that one of the points of contention for this bill was, well, this stops the institutional investors from being able to go purchase more homes under whatever entity that they've been purchasing under. But what if they were to go start a new entity name? And what this does not show, right? So we see a sell off of 3,000 homes in Q2 of 2026. It doesn't show who they sold it to. It
Right,
doesn't say if it's on the books to a sister company
right.
or to whatever. It just says that they're no longer on these books. And so
Yeah,
that's what's going to be interesting as this the whole thing unfolds is where were these sold to, and does this start to help the housing economy as we know it?
right. Or are we just going to have more conglomerates that have fewer homes each?
Right.
Pending home sales remain stronger than last year. Weekly pending sales reached 71,000, up from 67,000 a year ago. Mortgage rates have held below expectations. In other words, improved mortgage spreads have kept rates below a projected peak of 675, and buyer demand continues to hold up. Mortgage purchase applications have posted 23 positive year over year weeks in 2026, signaling buyers are still entering the market. Maybe buyers who thought, I'm going to wait for it to get less than six, maybe they said, well, how about less than 7,875? So
Yeah.
people get used to the current situation, and we know that to be true.
Yeah, we've had buyers being lied to for so many years at this point on how the housing economy is going to change in their favor. And they've been sitting on the sidelines since the second half of 2022. They've
Right.
gone through and they've been told about all these this influx of inventory that's going to be coming on the board, or that the housing economy is going to crash. And what are we seeing right now? Well, what we're seeing is all these people that have been sitting on the sidelines that have had children, that have moved, that have done something because of a job that has required them to now look at a bigger home or maybe even a smaller home. And they have waited on the sidelines for so long at this point that they've just gotten to the point where it doesn't make sense to sit, and they're actually going through and they're going forward with their buying and selling of real estate. And this shouldn't surprise anyone on this call because we are in the business of helping people buy and sell houses. And what we understand is this: they're motivated by life events. And so these are just the life event people that have been sitting on the sidelines, to your point, Russ,
Yeah.
and they have finally just jumped.
Yeah. When you have the baby, you got to do something.
Absolutely. It gets weird at a certain point if they're still living in your bedroom with you.
So, National housing inventory update for July. Inventory growth has slowed dramatically nationwide, up just 1.9% from June 25 to June 26. A year ago, inventory was growing at 28.9. So that's interesting. Also interesting here, Colorado is one of the 17 states that has more active listings than before COVID. And we've been talking about this. We've hit this multiple times. But, Colorado is in a select group. Actually, Charles, I feel like this group is getting bigger because we've looked at variations of this report, and I kept seeing Texas, Florida, Colorado, Washington State, Tennessee, and this report's got more. Maybe that those initial reads were slightly different metrics, but but inventory is specifically high where we are.
Yeah, absolutely. What's interesting about this is that we look through, and if we were to specifically talk about Texas, Florida, we have to keep in mind that those areas are bigger geographically than we are as far as people that are living in those areas. And so when we're competing against states like that have a bigger population than we do, like those numbers can be concerning that we have more inventory and less people than they do. And yet, what's interesting is we go through, we just looked at that slide number one, and slide number one was talking about how we have 4% less new listings on the board. We do have more inventory as far as months go. But then we look at this and we look at from 2017, remember 2019 and before normal market. Now we're in a abnormal market and we're getting more inventory on the board. But here's the thing, there's also more people. Right, we have to keep that in mind with anything that we're doing. If we were to look at like 2019 versus today, I don't know what the true number is, but I would have to imagine that we've increased our population anywhere between 2 and 4% over that time period. And so when we look at this number isn't to be concerning. This is just saying, hey, there's more inventory on the board, but there's also more people living in Colorado at the same time.
Yeah. Yep. All right. Last slide. This is on mortgage rates and the Federal Reserve. Mortgage rates remain elevated despite falling oil prices and a weaker than expected jobs report. And that's because bond markets are still pricing in a hawkish Federal Reserve. So the jobs report came out, 57,000 jobs added in June, which was below expectations. Unemployment at 4.2, which isn't a particularly bad number. Um, Oil prices have dropped to around $67 a barrel. I think last time we talked about oil, Charles, we were at $78 a barrel or
Yeah.
something in the high 70s. So that's good news. Housing remains under pressure from higher rates. What
Yeah.
else are you seeing in here?
This is one of my favorite conversations to have with real estate agents as we are going to and having our true north be the real estate economist of choice. And this is the conversation that we all have to be able to understand and be able to have at some kind of level with our people. And it's the dual mandate, right? When we're talking about the dual mandate that the Fed has, it's a dual mandate that says, hey, we need you to keep inflation steady and to make sure that we're not having too many Americans without jobs. Like
Yep.
that is what their dual mandate is. And so one of the biggest indicators that we threw on here was the crude oil. And we can see this and we understand that oil rates and the price per barrel is going to have a direct impact on the cost of everything because of transportation, right? Most things, especially being in a landlocked state like Colorado, is going to be flown in. And so when we're talking about oil, we know that oil is going to make sure that prices are going to go up or down depending on what the cost of oil is. Then we talk about unemployment. Well, unemployment is fairly flat, speaking across the times, but yet one of the bigger ones that we look at is that first graph that we have up front. And this is where we should all be watching. This graph, it says all employees around residential building construction. Well, here's the thing. If we're going through and we see this thing just bottom out to where there's no one working, these are our piece workers. These are the guys that are laying the tile. These are the guys that are putting up the framing. They're putting on the roofing. They're painting the house. If we start to see that number to where we're seeing it have a big decline, that means that the builders are seeing something. That the builders are going through and they're saying, hey, we have a real issue. And what they have the ability to do to be able to protect profits is to be able to stop hiring people. And so, as long as we see these numbers kind of stay where they are as far as unemployment goes under both of those sectors, we're not going to see interest rates drop, right? We're not going to see interest rates drop as long as there's people that are employed at a level that they're looking to be employed with. Because if anything that the last couple of years have proven is that we're not really going to be watching inflation. Inflation can go up and down, and they're not going to move the needle on interest rates inflation is what's going to be our inflate unemployment is going to be the number that's actually going to move that needle one way or the other.
Yeah. So, as realtors, Charles, what would you say? How would you say we need to advise our clients who say, I'm going to, I'm going to wait? Like, what do you say? How do you educate them?
Yeah, so here's the thing. As the real estate economist of choice, what we understand that if we are going to prescribe without knowing what their ailments are, that's malpractice. And so, as a real estate agent, our job is to ask them questions, figure out what their motivations are. Why did they call us in the first place? Because it's not that we were just looking or we were thinking, they are looking to purchase a home. So if someone's looking to buy and or sell, why was the reason why you called me? What is important about that to you? And what if you don't buy or sell? What will that do to you in the long run? And we're going to go through, they're going to answer those questions. We can't answer them for them. So if they say, oh, we are looking to move to this state so that we can be closer to our grandkids, and we would like to be there in the next 6 months. And then we say, well, what happens if we can't get you there in the 6 months? Where they say, well, that would be super unfortunate because we're spending a lot of time traveling and going to see them. And we know that these are the years that we want to be around them. Awesome. So now we've just gone through and we've taken all that information to figure out why they've called us. What are their motivations to be able to move? And then we're just going to counsel them from there. So we're going to look at the prices. We're going to figure out what the inventory looks like. And we're going to consult them from there because here's the thing. None of us are good enough in this industry to help someone and push them forward to spend $616,000. And it all comes down to motivation. So everyone's job is just to be the consultant, have the conversations, ask the questions, and then they get to decide is now the best time for them to move.
Yeah. And I think when you're talking about, so obviously when you're talking about the people that are upgrading, downgrading,
Mhm.
or just simply selling and buying, that's a conversation where you can talk what's happening in the economy with unemployment, what's happening with inflation. When you're talking to the first time home buyer, the other piece of it is what's happening with rentals. And we've had a number of conversations there about the challenges in Colorado with renting property. And it kind of becomes a what's the lesser of two evils kind of thing to me.
100%.
Yeah. So,
Yeah, when you're looking at this, guys, I mean, to Russ's points, it's there's going to be multiple different people that we're consulting, and not one size fits all. So as we're going through and we're listening and we're having the conversation, they get to be able to they're the driver in this thing, and you're just the one helping them realize what their options are to make the best decision for them and their families.
yeah. All right. That's all we got today. Have a good day and week, everyone. Happy 4th belated. Take care.
Bye.